While the Herstatt collapse made headlines in Germany, something even more mysterious was happening in London. A crisis with no explosions, no panic on the streets, just silence and shadows. Small banks, barely noticed by the public, were quietly failing, and the Bank of England was watching. But what exactly were these small institutions that were starting to crack? They were called fringe banks. So, when we say fringe banks, what exactly do we mean? Well, these weren't the big names you might recognize like Citibank or Deutsche Bank. Instead, they were much smaller financial firms that grew quickly in the 1960s and 70s. Some acted like merchant banks, some specialized in real estate lending, and a few were basically shady investment outfits. But despite their differences, they all used the same risky business model. Here is how it worked. They borrowed money on a short-term basis, cheap and quick loans that had to be repaid soon. Then they poured that money into long-term property projects, things like apartment blocks or shopping centers. This created a dangerous imbalance, short-term borrowing versus long-term lending. That mismatch made them extremely fragile. If interest rates went up or if investors suddenly pulled back their funds, these banks could unravel almost overnight. Well, this kind of imbalance, borrowing short, lending long, is risky even in good times. But in the 1970s, with interest rates rising and economies slowing, it was a recipe for disaster. Now that we understand how fringe banks operated, let's see what actually happened in the early 1970s. The UK property market was booming, prices kept rising, and fringe banks were lending aggressively to property developers and speculators. But then by late 1973, the tide turned. Inflation was rising, interest rates shot up, and the economy slowed. That's when the property bubble burst. Property values collapsed, developers couldn't sell, and banks were stuck with bad loans they couldn't recover. This is what we call a classic boom and bust cycle. First comes easy credit and speculation, then comes defaults, illiquidity, and collapse. And because these banks were so deeply tied to property, the damage was severe. This cycle wasn't just about falling house prices, it exposed just how fragile fringe banks really were, and soon the cracks began to spread. Now let's look at what happened next. In the early 1970s, inflation in the UK began rising sharply. And whenever inflation rises, central banks usually have one main tool to control it. They increase interest rates. That's exactly what the Bank of England did. Within just a year, short-term borrowing rates jumped from around 12% to 14% and then all the way to 17%. Now, why does this matter for fringe banks? Because their business model was based on something very fragile. They borrowed money at low short-term rates and then lent it out for longer terms in property deals. When interest rates were low, this worked fine. But once borrowing costs shot up, their entire model collapsed. Think about it. Their cost of borrowing kept rising, but the money they had already lent out was stuck in long-term loans, earning fixed returns. So every time they tried to refinance, it was like paying more and more for the same product. and that broke their business. You can make this relatable by comparing it to a person. It's like if you had a credit card with 12% interest and suddenly it jumps to 17%, but your salary hasn't changed. You would quickly find yourself in trouble. That's exactly what happened to these banks. Now let's connect the dots. Fringe banks borrowed short term, but their money was tied up in long term property loans. When interest rates spiked, their cost of borrowing exploded. At the same time, property prices were falling. The combination was deadly. Falling collateral values, inflexible long term loans, no fresh funding. This is called a liquidity crisis, a point where banks cannot meet their obligations even if their assets still exist on paper. And once one bank failed, confidence collapsed. Depositors rushed to withdraw, and soon dozens of banks fell like dominoes. The fringe banks had crumbled, one after another. The Bank of England stepped in with a lifeboat rescue, but the damage was clear. London's financial system was fragile, and trust was already shaken. But London's troubles didn't end with failing fringe banks. Behind closed doors, another story was brewing. Not just collapse, but deception. Next, we uncover the world of rogue traders and fake books.